GM, good morning. Welcome to the Milk Road Show, the daily crypto show. It's the calm voice telling you not to panic sell, like your friend telling you not to text your ex. I'm your host, Jay Hamilton. It's Thursday, September the 25th. The market is crashing. Everyone is panicking. Stay off crypto Twitter. It is ugly out there, folks. Ethereum's below 4K. It's red. Everything's red. What's going on? We are all together right now in Croatia, and we thought we should get together and give you guys an emergency flash update on what we are seeing and why we maybe aren't so panicked, or why we are a little bit more calm. You have to stick around to find out if we are panicking or if we are still calm. We got all the boys together. We got Chevy, lead writer on the Milk Road team. We got John, our macro podcast host. We got Kyle, head of research, and we got Martin over here, crypto investment analyst and head of Milk Road Pro. So whole squad's here. Before we jump in, as always, just do a quick favor, guys, wherever you're listening, smash that like button, give us a subscribe, give us a review. Hopefully you like our content. If you do, it really helps the show continue to grow. Today's episode is brought to you by Figure Markets. Grow your cash like a bank, no lockups, just real returns. It's also brought to you by Nexo, the platform that grows your crypto without locking it away. With that, boys, what's going on?
I just realized we should be having cheeky beers. We're not.
We should be having milk.
I've never had to sit in silence live through that introduction before,
Yeah.
and it feels much different. We're all just sitting here staring at each other.
You guys are doing great. All right, let's start with the question of the day, the question of the hour. You guys panicking?
No, not at all. I'll start with this. I think that the most important thing to do in times like this is to zoom out. Like, I'm the host of the Macro Podcast. This is a macro thesis, a macro asset. Zoom out. Don't over-index on what's happening this week. I think if you look at the long-term bull market structure for Bitcoin, personally, I would feel bullish until we close for like 2 weeks below 100K. To me, that's where we break structure. But we could drop another $10,000 on Bitcoin right now, and I wouldn't even break a sweat. I wouldn't even start watching the charts. Ethereum, I think, as you mentioned in the introduction, is another really interesting case. 4,000 was a resistance level for ETH for, I think, a better part of like 18 months, over a year. And it finally broke through there in August. What we're seeing right now, in my opinion, is just like a bullish retest of that level. Once that holds, I think we're just going to have a setup for another phase of the bull market, break all-time highs, off to the races from there. So I would just say, like, don't get over indexed on what's happening this week. Zoom out, look at the long-term structure of these assets, and don't let somebody post a meme that panics you out of your position. Just stay calm and hodl, and you're going to be fine. We're all going to get through this. It's going to be okay.
And for a bit of context, about an hour ago, just before we started this, actually when we decided we should probably do this emergency update, a few of us, John and I, and a few others, were sitting at this table just kind of working, and Chevy walked in through the door and he said, "Hey guys, ETH's under 4K. Are we panicked?" And our finance major was sitting here, and she popped her head up like, "What? It's under 4K?" And the rest of us were just continuing working like, "No, not at all," and just kept going. So there's absolutely no panic here right now for the reasons that John obviously said. I think we're still in the middle of a bull market. I think there's still plenty of room left. How long that's going to be, don't know. I'd recommend checking out the Milk Road Macro channel. John and I did an episode that I think actually goes out today as well, where we talked all about sort of the macro backdrop and where we see the top of this market, or at least how long we think it'll go. And part of that, I think we were thinking is it actually might extend farther into 2026 than we originally thought. You guys have heard me on here tons of times say, Q1 2026, starting to think that might even get pushed out even farther. And so until that point, until we start to see either inflation break out too much or things in the macro world break, which it's not, we remain bullish, and dips are for buying.
Martin, how are you explaining this dip?
Yeah, for me, it's just normal correction, nothing really going on. I wouldn't panic. I think we are still in a good position for the next couple months, and it's not a big deal. I think people should really just sit down, do nothing, and just stay focused on longer term horizon.
Yeah, gold at all-time highs, stocks at all-time highs.
But that's part of the confusion, though, right now, right? It's like we got rate cuts. Okay, yeah. We had a whole bunch of every KOL and every Twitter account was, posting the meme, rate cuts are in, here we go, parabolic. You start to see those words around. And then stocks and gold go, but why? But crypto's not.
Because we've known rate cuts were going to happen for, 2 months now or something like that. It's been pretty obvious. So that could and easily probably was already priced in. But what generally happens is we go through accumulation zones where we sort of just chop in crypto and in stocks and gold. And then generally it's not crypto that goes first. It's usually gold or stocks. Both of those have ripped. They're at all-time highs. And so I think it's only a matter of time until crypto follows. We were talking before the TGA, which we've talked about a bunch, at least in the newsletter. Not sure if we have on the podcast. But that refill was needed, and that's now done. So that was probably the thing that was kind of holding things back. And so I think gold and stocks are up. Generally, what happens, though, is, as John said, we've moved a lot. ETH has gone from whatever it was a couple months ago, like, I don't know, 1,400, I think it hit, all the way up to above 4,000, and so, or above almost 5,000. And so, we had these big moves, and now they need to come back. Leverage needs to reset, and it generally takes a little bit of time for that confidence to come back. It's easier for that confidence to come back into the stock market or into gold because they have just more passive buying and just like ongoing buying. Crypto doesn't have that yet, so it needs a little bit more confidence. So generally, your less riskier assets like gold and stocks will go up first. Will follow. So I would imagine, give it another week, 2 weeks, and you'll be laughing.
Any insights on what caused this? Then why is this dip happening? If everything else is going up, is anybody have any insights on flows and why flows are not coming in or why flows are going out of crypto? I know it's a very specific question that nobody might know right now. I'm just curious.
Yeah, I think that the clearest sign the clearest insight I think I could give on this is just around what happened with the big liquidations that we saw. I think we saw around $1.6 billion of liquidations. Primarily, those liquidations happened in the Ethereum market, in the altcoin space. And in the past, when it was more like Bitcoin season, most of those liquidations we would see would be in the Bitcoin market. What that indicates to me is that a lot of investor interest, attention, and leverage has shifted to the alt space, which means in all likelihood, a lot of people just got a little bit too excited and over anticipating alt season, taking out leverage to articulate that thesis, got a little ahead of the markets and got washed out as a result. But again, I think that's a bullish clearing of leverage in the system to allow a setup and kind of like reset a lot of these Bollinger Bands and everything and allow us to continue higher in a more, let's say, sustainable way. But so to me, that's what I see.
It can't be up only.
It can't be a ball. We're going to have some wiggles in the chart, but yeah, to me, it just seems like people got a little bit too excited and over anticipating alt season and got washed out, taking out leverage on that.
Like, what are we down? It's like 16% on ETH. That's it. Like, what are we even talking about?
It's a pullback for it.
Yeah, pullback for it. I don't know what we're so concerned about, but that seems pretty natural and normal to me. We're down like 5%, 6% in Bitcoin. Whatever.
I also feel like summer was quite bullish for crypto.
Yeah.
While usually it's very calm and nothing's happening, but I feel like a lot of these flows were driven by these digital asset treasuries. So we might sort of front run the market a little bit, and with all these new vehicles pumping the market, and now we really need to like a pause or reset the market a bit, and then we can continue. It might be also a reason.
When would you be worried? When would you panic? What would it take in order for you to say, okay, this dip has me worried. This has me concerned.
If Michael Saylor sells.
Right now, I would say there's not a price that really has me worried too much. It would be more on the macro side of things that I'd be looking at. If the Fed decides they're not going to keep cutting rates and they're going to change, and they're going to raise rates or something, sure. I don't think that's going to happen. If inflation really made a big move upwards, now that's not just meaning it goes up. It's going to go up. I think that's normal, and it should go up because that means the business cycle is picking up. But if it really had some crazy spike, I don't see why that would happen now. There was a chance maybe it would because of tariffs. That didn't happen. And so I would say if inflation really took off, or if something happens with the housing market, and actually John just did a video, an interview 2 days ago when it's gone viral right now on the Milk Road Macro podcast. So again, go check that out. And there is some things brewing in there, but I'm not sure it's as bad as many think it is. But that was a good, insightful podcast as well.
Any takeaways from that?
Yeah, I mean, I think I agree with that take in the sense that, like, if something major shifted from the macro perspective, obviously that would have a big impact on the market. Right now, I agree with Kyle that although there's some risks of those things happening, there's always some risks of that happening, and nothing seems like likely to me. So for now, I think we're more likely to continue on the trajectory we're on. As far as price levels where we get bearish, I would say something I've been looking at as a kind of like a general rule of thumb, something I've had in mind is that if Bitcoin closes below the 50-week moving average, spends 2 weeks below there, generally speaking, historically, that's marked the top for Bitcoin. So it doesn't usually recover if it does that. That right now is somewhere around 100K. So if Bitcoin wicks below 100K, I'm not worried. If Bitcoin drops below 100K and stays there for a month, we've probably rolled over. But again, these are not decisions I'm going to make in a panic on an afternoon. I'm going to be watching for sustained price action at those levels and a general break of market structure, which I just haven't seen anything close to that happen on any of the major assets in the digital asset space.
Martin, Chevy, anything to add?
Do you want to add something, Chevy?
Perception is a hell of a drug. September's a historically bad month. We've had a good one. It's now flipping back into business as usual, but it feels different because it's been so good. We've been looking at Bitcoin dominance. We looked at it break support. It's been building over about 4 years. And, in an ideal world, you see it come and retest new resistance. It looks like it might do that. Bitcoin, gold leads Bitcoin by 3 to 4 months. Gold went up sideways and then ripped between January and September. Shift that forward 3 months. You look at Bitcoin, it's ripped sideways. So hopefully in Q4, we'll see that last minute spike. Yeah.
I think once Bitcoin do new all-time highs and Ethereum and these big ones, then it will be the bull season, the start of the bull season again. But
continue.
no, it's just we need some clear catalyst, which will okay, here we are. This is the banana zone, and let's fucking go. And I think it's gonna happen soon.
Yeah. I think we got to remember how crazy it was in, July when we had all the craziness in the ETH stats. It was a really wild time. These things were going premium above 2. And so you needed time to kind of digest that and reset. There's a lot of funds that want to invest in these DATs to then go and allocate to more ETH or to more SOL, or there's a lot of DATs coming right now. And that tends to take time. And so I know a lot of the funds that want to do it, they kind of wait. They make sure that everything's all good, right? They don't tend to rush into things that are brand new. And so I think there's still a lot of capital to flow into these over the rest of the year here and probably into 2026 as well.
I want to pick up on something you just said, which was still bullish, feeling like that next bull run is coming, but we need some catalysts. What could those catalysts be? What could we be watching out for?
Well, I feel like we are getting these catalysts every day, but people really need to see price action, right? So until we don't see new all-time highs, hitting all the new headlines again, and reactivating all these people that have been not interested in crypto at all, your friends messaging you, hey, what's going on with crypto? We haven't seen it yet. And so I think we really need not just Bitcoin, maybe also ETH or some, other coins hitting new all-time highs, which is going to unlock this new wave of capital coming in. Yes, institutional are coming for sure, but I think it will be slow. It won't be now we are at 4 trillion for total crypto market cap, and it won't be 10 trillion tomorrow. And I think institutions will not do all that race, basically. We need that retail as well.
But you think retail could be the catalyst that gets us to...
It's both, actually. But the big jump that we are all expecting is going to be primarily by retail.
Yeah, well, and it needs price action before retail makes that wild jump happen. I think what we'll see is, and it's not necessarily anything that's going to be one big catalyst. Last year, we had Trump winning the election. Boom, we took off, right? And we don't really, and then earlier in 2024 was the Bitcoin ETFs. I guess that was even end of 2023. We sort of realized, oh, these are happening for sure, right? So you had some of those big catalysts. Now I don't know that you have some big boom, but you just have a bunch of demand coming from the DATs that I just talked about. That's not stopping. That's going to continue, and they're going to launch more things in different structures, kind of like what MicroStrategy has done. You're going to have more ETFs coming across the board. You're going to have staking for ETFs coming. And then the other really big one that I think is going to happen, and this is going to take over a year to play out, which is as rates continue to come down, of course, that's bullish for risk assets. But what that's even more bullish for is the fact that there's, you were saying yesterday, $7 to $8 trillion in money markets right now, I think, in the US.
Over 7, yeah.
7.7.
trillion. And so the rate right now is 4.25, I believe. If that goes down to around 3% over the next 12 months, where are they going to go to get more yield? They're not necessarily, yes, some of that capital go to risk assets, but not a lot of it does. Most of that capital needs to remain in dollars or kind of low risk. So where could it go? Stable coins with yield. That's becoming the thing. And the thing is that when rates go lower, the yield in DeFi goes up more, right? The yield in the traditional world goes down. The yield in DeFi goes up. And so I think, and now for the first cycle ever, we actually have good, legit stablecoins that generate yield in various different ways. You can use it with Coinbase, right? By putting it into USDC. You can put it in Sky. You can put it in Athena. There's actual institutional grade yield-bearing stablecoins or ways to use stablecoins to generate yield, whether that's using DeFi protocols, et cetera. I think that this is the year that we finally see that. Now, not necessarily Q4, right? Because we're only going to cut 2 more times by the end of the year. But throughout 2026, I think we're going to see, we're already seeing crazy growth in stablecoins. I think that's only going to continue. And so I don't know that we're going to have this one big catalyst yet, but I think we're just going to have this continuous demand and continuous adoption and continuous flows, which is what continues to lead me to believe that we probably have a longer cycle and we're still, I don't want to say early stage, but let's say mid stage maybe.
Mm-hmm. Any catalysts that you guys want to mention?
I agree with everything they've said. I think every week that has passed, and it does feel like every single week there's some kind of bullish news, but the fundamentals of the digital asset space has gotten stronger and stronger. That's been supportive of price, but we haven't really seen like this massive breakout. To me, I think that means a Bitcoin at 150 and Ethereum breaking and holding 5K. I think that brings a lot of retail interest back, and I think that will be the catalyst because, like Martin said, like, the fundamentals growing and getting strong. People who are in the space are watching that and seeing that and understand the value that's being added there. But until the price action breaks some huge level and people get this FOMO to come back into the market, I don't think we'll see a catalyst like that. So for me, what I've been watching is 5K for Ethereum. I think that is the thing that'll bring back the FOMO, and that'll bring that back to the altcoin space. Like, I don't think retail is going to come FOMOing back into Bitcoin at 150. Right. But I do think once ETH breaks 5K, you'll see a massive breakout in the rest of the asset class. I think that's the catalyst that we're going to see. I'm not sure exactly when that'll come, but that's what I'm watching.
It's kind of like when Bitcoin hit 100K. I was starting to get text messages, right? And so that brought a bunch in because that's like that number that everyone cared about and heard about. And I think you'll get that same thing with ETH at 5K, Sol at whatever the all-time high was there. Those two things are very retail-heavy assets. And so when they start to move, that's when people come back, right? So that could be the big catalyst, you're right.
Why do people invest in real estate? Because it spits off cash flow. But I'm not here to manage rental properties. That's why I'm looking at Figure Markets. Their new democratized prime product backs your money with real cash flowing assets and returns up to 9% APY. It's the first real world asset borrow lend pool built for everyone, not just institutions. Ready to lend like a bank and get more than the 5% Aave is offering you? Download the Figure Markets app today and get 9% on your idle funds. Go to milkroad.com/Figure Markets.
If long meetings and judgmental bankers are your thing, Nexo's probably not. Nexo is a premier wealth platform built for people who value their time and money. It's built for people who have idle cash lying around and want it to grow fast. Whether it's Bitcoin, Ethereum, or even Forex-pegged assets like USDT or USDC, Nexo offers up to 14% annual interest and access to crypto-backed credit in under 24 hours. Your assets need a platform built for growth. Join Nexo.
Interesting. Let's talk about the outlook for the rest of the cycle. So, and I want everybody to focus on, try to position Q4 and then go beyond. Do you see us having this bull run in Q4? What's your probability versus what's your probability that this extends into 2026? And do you think that what probability would you assign to Q4 of us hitting these larger goals of like 150 Bitcoin? I mean, 5K ETH didn't seem like a big goal about a few weeks ago, but it does now again. Versus what's the probability you think that big pump doesn't come until 2026?
I'd be very surprised if it took till 2026. I think Q4 is going to be a big quarter for crypto. In terms of what price we get to within that time frame, honestly, I don't know. But Q4 tends to be a very good time for crypto, regardless. So I would not be surprised if Bitcoin was above 150 in Q4, and ETH is definitely all-time highs by then. I'd put a high probability of that, so let's say 80%. And yeah, I'd be very, very surprised if we weren't much higher by the end of this year. Now, I still believe that we're going to go farther into 2026, whether that's Q1, Q2, Q3, Q4, even in 2027, I don't know. I have the probability for all those. I think there's a chance that this could extend far longer than we all thought. Partly because I think in April, when the tariffs happened, I think we sort of reset the cycle. And what's interesting is, when we started the cycle back in 2023, Bitcoin was around 20K, 16K to be exact. And we started the cycle from there, right? We went all the way up to, whatever it was, 100K or something. And then we had this big pullback from the tariffs. And that basically reset the business cycle. It reset a lot of the liquidity cycle, the pricing cycles. And now it's like this cycle is actually starting from 80K instead of 20K, which means if the cycle is just starting and the floor was 80, that was where we started at. Well, that means we've got a lot more room to go from here. And so I think that's actually going to extend much farther into 2026.
So basically, tariffs caused the smallest bear market of our lives, and now we're in.
And Bitcoin was barely impacted by it.
Yeah.
Bitcoin was so strong during that time, but it did, in my opinion, from all the data points, it looks like it reset the cycle. And we were saying that in April. I was like, this is kind of weird. Like, remember, we never really hit the business cycle above 50 in the ISM PMI, and we sort of reset it, and now we're kind of on our way back up. So.
We've been writing a lot about that in the Milk Road Macro newsletter, how a lot of analysts now, with a lot of the revisions of the labor data and other things, have been saying that there's been small recessions or sharp bear markets in the recent economic past. And so that kind of does support that thesis that maybe we are starting a new cycle, or the old other cycle was delayed, however you want to phrase it. But it does seem like a lot of that's been processed by the market, and that there's opportunity for an upside there.
But the thing is, I think a lot of crypto Twitter anyway, you hear so many of them saying we're at the top. But that's because they're anchoring to that 20K Bitcoin, right? And so, okay, 120K, that feels reasonable for an entire cycle. But if we started the cycle at 80K and we're only at 110K, would you be screaming for the top? You'd be like, no, this thing's just starting. So I think we need to change our anchor.
I think one thing I'll say is that I'm really interested to see what happens at the next FOMC meeting for the Fed, because as we've said, there's been a big, a $500 billion liquidity drag on from the Treasury Department refilling their general account. So that's been some liquidity that's come out of the market. The market is pricing in, I think, at a 94, something like that, % probability of another rate cut in October. If we get that, I think that's confirmation that the Fed is kind of sticking to this more dovish path. It gives investors more confidence to deploy more assets, like risk assets. There's less liquidity drag. Some of this capital from the what we talked about, the money market will come back into the market looking for risk assets. I think it'll just be supportive. So you're asking me probabilities that we get new all-time highs. I think once we get to that checkpoint, that is going to give investors much more confidence on the path of the Fed, much more confidence about liquidity, interest rates, and I think that'll give us an idea of just how bullish Q4 will get. But if we get to that point and we've gotten, we're going to get some inflation data before then. If it's blown out of control and Jerome Powell says, never mind, he pivots to more hawkish tone, maybe that delays things more. So I'm kind of watching to see what happens there, because I think once we get to that point, that'll give us a pretty clear view of the road for the rest of Q4. And so I'll feel more confident there. But for right now, and until something major changes, the highest likely, I don't know what number probability I would assign, but the most likely thing is that we continue higher, because liquidity is going to keep flowing, and that's the path we're on until it changes. There's no reason to think it will.
And we've talked a lot, we've had in the newsletter a ton about the Dixie, right? Looking at the dollar. The Dixie is a lot of basically comparing the US dollar to the euro is a big, big part of it. And what's interesting right now in terms of dynamics is the US is finally starting to cut, and the euro or Europe has actually stopped cutting, right? And so they've kind of announced that they're gonna hold for a bit here. And so what this tells me is likely the Dixie is going to go lower here, which is generally the catalyst for Bitcoin to go much higher. And so I think that's what we're going to see. And the other reason I think you should not be thinking this is the top is because, one, the US is just starting their easing cycle, or their cutting cycle. Maybe the easing comes with it. But don't forget, China's also over there doing the same thing. So you have the two biggest economies in the world that are going into an easing, not a tightening. And so never do you see a bear market come when you have the biggest economies in the world easing rather than tightening.
My mental model is I think we are gonna do all-time highs by the end of this year, and then January, I don't know, Q1 maybe might go some correction, maybe a little like bigger one than we are used to. Well, we are used to big corrections, but something like maybe let's say 30% or something. And then the discussions around, okay, Paul's gonna be replaced by someone who is gonna be more aggressive with rate cuts, and when the markets are start to pricing that in and like trying to front run, okay, the money are going to be super cheap, so like people and investors are trying to front run that news, and like it will probably create a next pressure and create a new highs again.
What's interesting about that is that's exactly what happened last year. Trump won, the markets went berserk, thinking, okay, he's going to come in, all the policies are going to change, let's front run that, and we went to all-time highs in Bitcoin and beyond. And then once Trump took office, we had the huge pullback. Feels like maybe it's the exact same thing. Be very interesting if that's what ends up happening. I mean, it looks like it is. We started rate cuts in September, just like we did the year before too. There's a lot of very similarities to what happened.
Chevy Q4 2026 outlook.
Yeah, look, it's been a slow grind up, and I wouldn't be surprised to see it slow grind continuing throughout 2026.
Yeah.
I've been sitting here trying to think of like, what is that blow off top, like that 2017 era? Bitcoin was at $5,000, all of a sudden it's at 20.
You got to remember that the administration wants to run it hot.
Yeah.
What does that mean? It means we want to pump markets and we want to do it for an extended period of time. That's not what they're trying to do is pump markets. They're trying to run the economy hot. But running the economy hot means that markets are going to keep running hot. And if that's their goal and that's what they're continuing to do, then don't fight the Fed. Right?
And is it
don't fight the administration.
Is it just a situation that we're in that it almost feels unbelievable that the S&P could have a third year in a row of 20% plus return? That is something that we have not seen before, and that is why we were in this position of such a dichotomy of two sides. You can find the bears are loud and the bulls are loud. Everybody's loud right now, and nobody's in the middle. Everybody's on either side, right? And is that because we are in a new system, a new regime as a result of things where maybe, bear markets are shorter than they've ever been in the past. And structurally that was a bear market maybe. And we just have to shift our viewpoint to this new reality. And there's a lot of people who haven't done so.
I also feel like it's not just crypto that's now changing the market. It's also AI. Yeah. And there's so many unknowns. Like, we cannot say for sure what's going to happen in 3 or 5 years. Like, we might see our economy like completely rebuilt, and like the services that contribute to GDP are going to change a lot. And like, I think it's very scary for some investors in that regard. And so it's not just crypto, but it's also AI adding, a certain level of who knows what's going to happen.
You also got to remember that, forget crypto for a sec, but think more about stocks. The stock market is typically over time valued on earnings, right? And as more and more tech is put into these companies, or these companies launch more and more tech, their companies become more and more efficient and more profitable. And they can create more and more earnings. And especially with AI, that's going to create, that's just going to make that exponential. And so earnings are going more exponential than ever, right? We've never had earnings grow as fast as they are. And you also we've never had as much debt growing as fast as it's growing too. What does the combination of those two things mean? It means the valuation of assets must go higher along with that. And so to me, it's like, again, we need to stop thinking about how the world used to work and how the stock market used to perform, because that's based off of earnings that didn't have AI and didn't have blockchain and didn't have robotics and didn't have all the things, the technologies that we have today, right? So we've talked about the exponential age for years on this show. And that's really what's happening is technology is going exponential. And as a result, the price of assets are going to go exponential along with it. And it's exponential is very difficult to model. 100%. Right? It is not. It's hard for the human brain. Exactly. So we have a company, NVIDIA is at $4 trillion today. I don't know about you guys, but if you were investing in 2019, $1 trillion company was a weird thing that didn't exist. And 2021, or maybe it was 2020, was the first time we had a company where we're like, whoa, there's $1 trillion company. I think it was maybe Apple or something, or Microsoft. And we're like, wow, this is crazy. And it's 4 years later, and now we have a $4 trillion company, and we have like, how many companies are over $1 trillion? Like 5 of them at least. And so like, I was saying this on the podcast yesterday, I think we're going to have a $10 trillion company very soon and a $20 trillion company not too far off either. Could be 3 years from now, maybe 5, but I would imagine it's 3. So like the frameworks we used to have, you need to throw those out the window, right? We need to be in the new world, and that's a tech-driven world and a debt-driven world.
Milk Road Macro. Or Macro.
Exactly.
No, Milk Road Macro. So one other thing I want to say on this is that, you're talking about it's hard to model, and like the S&P has got, the third year of 20% returns. All of that you got to remember is in nominal terms. And what that means is that we're valuing it in US dollars.
Right.
So if you're denominating everything in US dollars, you have to remember that the US dollar has been obliterated, right? We printed $6 trillion in 2020. So all of these models historically have said one thing and like, oh, we're at a bubble, we're overvalued. But we have this situation where there's this huge amount of liquidity that's been dumped into the system that's desperate to find somewhere to go. Usually we've just gone into the bond market, but we've seen this sovereign debt crisis where nobody wants to buy long-term debt from any Western government. And so there's this desperation to find somewhere to put all this liquidity. A lot of it's gone into gold, and that's seen the biggest bull run in its entire history. That's going to continue, I think, because still there's an enormous amount of liquidity desperate to find somewhere to go. It's going into gold. It's going into these hyperscalers for AI. So yeah, I think the S&P will continue to be overvalued because like you're saying, like it's hard to model exponential. The denominator that we're using in all of our models is totally busted too.
Right.
So it's just like we're going to get to see a lot of things at valuations that historically would have been sane, but because of how fast the dollar's lost value, are going to just be the new normal now.
And you make a good point there, which is a lot of the capital used to go into bonds or into gold, right? That was the old version. And why did it go into gold? Well, all the same reasons of Bitcoin, right? But it's a rock. And then why did it go into bonds? It's because countries were so important, right? Like governments, they ran the world. But nowadays, who's bigger than governments? Who's more, I don't want to say trustworthy, but who's growing faster and producing more profits and making a bigger impact on humans and on the world than governments? Tech companies. Meta has 4 billion people in their network. The US has 350 million or whatever. So tech companies are becoming a bigger, more important asset or thing in the economy than governments are. And so the bond market's breaking because people don't trust those anymore, right? But we do trust Apple and Microsoft and Nvidia and these massive, massive, massive companies. And then, of course, we now have crypto, things like Bitcoin and Ethereum, which we don't have to trust anything. And so there is better assets that you can put your money into, whereas previous gold and bonds were your option, right? That was your big thing. So the world is changing.
So pretty much money supply is growing faster than ever, and more money end up in the markets.
Yeah, exactly.
And you have to remember,
but in the seven companies.
Right.
Nothing else.
And then just for some perspective, the whole crypto market is like a little bit under $4 trillion right now, and the global bond market is closer to $400 trillion. So we're talking about enormous amounts of capital that is desperate to find somewhere to go, and that's why we're seeing these crazy valuations happen.
But it helps America to get demand for bills, right? Like there is no one else buying US debt, but there are stablecoins. So like you make sure, okay, you want to use stablecoins? Sure, but it's going to be backed by our bills, creating a pressure because the stablecoins market, like even, someone from US government is expecting stablecoins. Right now we are about 300 billion, I think.
Close to.
And they are expecting it to rise to 2 trillion or something by 2030. So it's an enormous growth. And if it's backed by US treasuries, it's going to create a more buy pressure. And it's good for America, right? So they can benefit from it. So that's why they are so supportive for stablecoins and this whole movement, because it sort of helped them to, go longer and like play the music longer, right?
Mm-hmm. So. I don't know if you guys heard the little nugget there, but you said the entire crypto market cap is worth 4 trillion. And before that, I said Nvidia is worth 4 trillion. So you have an entire industry worth the same as one company, right? So if you look at the size of the stock market, it is, I don't know, hundreds of trillion.
120, I think. 120
trillion. And you look at crypto, it's 4 trillion. And so then you look at the pullback of 16% today. Do you care? Don't give a shit. Because where do you think that the crypto industry is going when it's only worth 4 trillion? We've said many times 10 trillion probably by this cycle, so by next year, but eventually it's going to 100 trillion, right? If not beyond. And I would imagine it goes far beyond that. And so does your 16% dip matter? Does your 25% dip matter? You said the big one is 30 coming in January or whatever. Does that even matter? If we know that the road is actually going to 100 trillion, who cares? Who cares?
Chevy, what's your line about patience?
Yeah, I've been pretty patient in my own holding. Like I'm typically quite an impatient person, but I've been able to hold for a while. The question that I wanted to ask was looking back at like the dot-com bubble, there were a whole bunch of promises that were then fulfilled over 2 decades.
Yeah.
But the dot-com bubble happened because everyone was like, it's going to happen in the next 2 years. Realized that wasn't really feasible. Everything collapsed. With AI, it feels like it's moving at a pace right now, at least that I can see the demand is just not dropping off and the revenue, the earnings are there that weren't there in the dot-com bubble. Do you foresee a point at which there could be that gap of like, we've kind of reached that plateau. We don't have that like hyper growth in front of us over the next 20 years. Yes, it's going to be adopted.
Yeah.
But there's going to be some short-term pain.
We tried to draw little charts with our hands during the podcast yesterday, but very much I think that's going to happen. I think with AI, the amount of capex coming into AI right now is in the trillions, and it's massive. There's really an unlimited amount that can continue to come in because we need to build such large data centers. We need to build so much more innovation around energy to power those things. There's so much more we need to do in AI, and right now there is demand for those products. But as that grows, I think we're going to outgrow it. And so at some point, we're going to, here's the CapEx and the spend. Here's the actual like utility of AI. And so at some point, we'll have to come back down, right? Same thing that crypto's been doing. It's like this, right? So we're definitely, and who knows if we're already overbought in terms of the AI side of things. But I think we'll definitely have pullbacks along the way, without a doubt.
So the next question I have is like, I'm Australian. Most countries, most countries like retirement funds. Yeah, most countries will be reliant on the US economy. Like all of our retirement savings, our markets just aren't big enough to back ourselves. So we go to the S&P.
Yeah.
The question I have is like, is there worry around 7 companies essentially representing the S&P, and when that pullback comes, they're all trying to push around AI. I mean, Tesla, yeah, but they're a car company, but they're an AI company.
Yeah.
Is there some systemic risk there where it's like global financial crisis 2.0?
Yes.
Okay.
Yes, next question.
That's for another emergency. No,
I thought we were supposed to calm everyone.
Yeah, there's a lot of bears in the market because it's easy to see and to build a strong bearish thesis. That's something that makes me a little bit bullish because if everybody's bullish, that's when
that's when you
top. But yeah, look, I think there's some risks to this. Nobody's quite sure how this is going to play out or over what time frame. But yeah, I think that there's a lot riding on those 7 companies. Yeah.
But I would say there isn't systemic risk like there was in 2007 with the real estate market, right? Because these companies that are in this sort of like, call them a bubble or whatever they are, we don't know if we're in the bubble yet, but they actually have real cash flows, they have real revenues, and they have sitting on billions and billions and billions of dollars of cash. In 2 years from now, who knows? Maybe Apple has $1 trillion instead of $500 million, $500 billion like they have now. So like, it's not like those things are levered up to the tits and it's going to cause this crazy systemic risk. Now we'll see where things go. Of course, there could be levered play as rates come down and they start to take leverage, but they have they're making hundreds of billions of dollars and they have hundreds of billions of dollars in cash just sitting there. So there's a lot less than what was going on in 2007 when the housing market blew up because it was all leverage, right? So it's a little bit of a different scenario today if you're comparing those 7 companies. Now, there is risk of 7 companies basically running the entire world because the world is moving more and more online. And not only is the world, like humans have moved online, but as robots and cars all become AI owned by one or a few companies, yeah, there's definitely risk there. But in terms of like a leverage play, like let's say 2007, I don't see that right now, although there is issues with the housing market, of course. But we're talking about those 7 big companies. It's less of a systemic, I would say, today. Who knows where that goes?
Cool. All right, I'm gonna wrap us here because we have achieved the goal, I hope, of calming everybody down that's listening with this emergency flash update. This is a pullback for ants. Still, let's go around. Still bullish.
Yeah, mega bullish.
No.
I remain bullish.
I am very bullish.
All right. Well,
you
still bullish? Yeah, still bullish. No, I feel the exact same way. Thanks for tuning in, y'all. Appreciate y'all taking the time. We will be tomorrow's episode. Actually, we're going to dive deeper with Martin on the 6 trends and the 6 themes that we think are most important to capture this coming bull market. So tune into that. Have a good, awesome day, everybody. Thanks for tuning in.
Thanks, guys.
If y'all are making swaps or trades right now, highly recommend you check out Milk Road Swap. This is a DEX that we built in partnership with Cow Protocol. Why did we build it? Not to make money, just honestly so we could have a place to do our swaps for the lowest fees that we could find. This is the fees on Ethereum, Arbitrum, and Base are only 0.15% fees. This is a huge difference from other centralized exchanges that charge 0.5% or even up to 1.2% fees on their swaps. Also, you can swap on Solana, all at swap.milkroad.com. Check it out today. You won't be upset. And you can join me in my favorite place to make swaps on chain. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only and nothing we say is financial advice. Investing in crypto or any asset is risky and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.